you spoke a bit ago about your preferred metric for valuing smart contract blockchains is what you call GDP, which is basically just the combined app revenue on these chains. And you use that to sort of make the argument that Solana's like future earnings are pretty discounted. I just want to hear more about that, because I think we're having this conversation at a time where I don't know how much you personally are on crypto Twitter, Geoff, but crypto Twitter is alight with lots of debate, especially between the Solana and ETH world, about what metric should you use to value layer 1 tokens. Blockworks has this thing called REV, which basically measures fees and tips that are paid to get access to block space, and that's like income to validators and then to stakers. App revenue is a little bit different, but also obviously a way that value is created by L1s. So just walk me through why you think this GDP app revenue metric is the best way to think about how valuable an L1 is.
Yeah, there's I kind of come from one of two angles. So one, the simple angle is if you do it across a few chains, you get numbers that look somewhat similar. So that's super helpful, right? It's sort of like saying, and actually I don't have the PEs for stocks in my mind, but it's sort of like saying the PE for Apple is 10 and the PE for Microsoft is 12, and for something else it's 8, and it's sort of 15. So the numbers are kind of similar. You're not having like Apple PE of, in my made up numbers, 10 and like something else of 350. You know what I mean? So when you do this market cap divide annualized GDP measure that I'm talking about, you get similar numbers. Now, they're not 8s and 12s, they're sort of 50s and 100s, but still, you're kind of in the same ballpark. So I feel like you can then do a little bit of an apples for apples across blockchains, which is extremely helpful. And then you can at least within logic space say, for example, BNB trades slightly rich on that metric. And I would say that that's because of the Binance exchange, they have some, let's say, captive audience, right? So they've got a bit of a moat. For Solana, it trades a bit cheap. And when I compare their uses against Ethereum and Avalanche and BNB, they're basically entirely meme coin trading, whereas the others, obviously, particularly Ethereum, are a bit more of a portfolio. Yeah. So again, it kind of goes back to like what an equity analyst might do, where you'd say, if you're all in on one use case and that use case is risky, maybe your PE is lower. If you're kind of diversified, maybe your PE is slightly higher and a bit more stable. So it's getting to a similar place, quite frankly, because the numbers match up. It's helpful. Like it's a reasonable way to do it. And it's a sort of same idea that you might use in equities. And the second is to say, if you think about blockchains as being their own countries or their own cities, I know people use that example sometimes, like the activity in that country or city is interesting to use as a metric, right? And so that takes you back to the fees paid on applications as kind of like a metric, which is interesting. And then you think about like as that rolls up to the overall chain and has fees and stuff like that, the net token issuance, which is essentially equivalent to like a government deficit type measure, will be impacted by the fees that are generated, which is kind of like a tax in the country system. And the fee is impacted by the activity paid by end users, which is, the kind of my GDP measure here. So it sort of works both in logic space, comparing chains against real world countries or cities. You can then compare, for taxes and think about the overall thing as like a government, which again, I think makes sense. So there's good logic, and the fact that it matches up across chains and has some similar logic behind it to like what equity analysts do, I think makes it a very usable way to think about it. Others, let's just say outright fees or those sorts tend to be so volatile across blockchains as to be basically unusable. So this one for me at the moment is making a lot of sense.
Wait, so do you factor in issuance?
Yes and no. So I think issuance matters at an extreme. So, obviously, for example, Ethereum got to negative net issuance before Denkin last March, and now it's positive net issuance. Does it matter? Yes, no. I think it matters, yes, because it was negative, now it's positive, but activity probably matters more. And I also think about it like most of these chains, like, net issuance is sort of 4 or 5% for Solana and others that, in the top 10 or so coins, as opposed to more extremes like when the earlier days, right? So I think if you're in the sort of 0 to 4 or 5%, it doesn't really matter massively. It's sort of like, let's say Amazon, for example, their net issuance on average over the past decade is like 1.5% of new stock. I think that's all fine. Like, it's not a big deal to be kind of in those low single digit numbers.
I guess the point here that's catching me up is I don't necessarily see how like a market cap to app revenue ratio is like a fair ratio to take, because I do get that the market value probably does value these together in some way. Like if Solana has popular apps, the market will value the Solana L1 token more highly. But it's not necessarily the case that the apps. It's like the apps could have a really high take rate and then settle very little data to Solana, and so there's actually not a lot of like value capture for Solana from these apps. So to me, it seems like the actual, I get that fees are very volatile, but it does seem like they're worth looking at, because maybe it's a more comparable metric to what the market cap of the asset is.
Yeah, for sure. I suspect there's an over time question here, because the blockchains are new, and quite frankly, because actual app, use cases and fees paid to applications is also new. So we're talking, a number of quarters or a few years, really, in any of the blockchains to have had enough fees paid to applications to be measurable, basically. Your point there could be very well made that over time, particularly if take rates change on applications, which I think if we fast forward sometime in the future, I think will be the case. And at that point, you'll also then start to think about, should layer ones have the premium that they have today? Yeah. So if you do the same type of metrics for the layer twos, who quite frankly are completely minting it from a cash perspective, paying Ethereum almost nothing and taking quite a bit for themselves. If you do those metrics, they are totally different levels. So the market values them completely differently. Now, partly that's because, tokens have different uses and stuff like that. But at some point, I agree with where you're going there on fees mattering more and take rates mattering more than activity. And that will sort of blow up the whole thing. Like layer ones actually probably come off a lot and application prices go up a lot. Like if we step back and sort of look at where value lies, it's been remarkably stable that the layer ones have captured all the value in a market cap sense right through. So it's sort of like saying in your phone, iOS or Apple gets all the value and the applications built on it get zero. Now, in the Apple example, the corporate can force that outcome, but in blockchain space, that's not really possible. And it's kind of the whole point of blockchain, right? Is that value should get passed down or kept by the applications. We just haven't quite got there yet, at least in market cap. Maybe it's because we haven't got like a real use case. Like maybe Uniswap could be the first version I could imagine where this goes, right? So at some point, the Uniswap the amount of take rate will change dramatically for Uniswap, and or they'll have their own layer one in scale, and that'll change the business model where we say actually it's the applications that have value, not the blockchains, not the layer ones. But I'm not sure we're there yet, I guess.
Yeah. And I think this is something that Solana is thinking a bit about with like application specific sequencing, where they're maybe trying to plan for a world where maybe some of these breakout meme coin apps say, hey, I'm driving an awful lot of value to your validators. Why don't I just keep that for myself and then move their app to their own layer 2 equivalent or their own layer 1 or something like this? I think Solana has to really make this global shared state vision very appealing and have like multiple breakout sectors where you would want to be directly composable because you're all on this ledger together on Solana. And if you go be on your own layer one, people can't move assets there very easily. And that's like a downside. Like I think Solana has to really play into that to outrun this future where, apps want to capture more value as opposed to passing it on to Solana validators.
Yeah, I agree. It's sort of it feels a bit circular to me, right? So you have, as in most technologies, you have the layer one gets built, then applications get built on top. Their value was enabled by the layer one, but then when applications get large enough, they kind of create all the value in the ecosystem, and so then you get a little bit of a breakout down the track. Interesting, you point out that Solana will be trying to manage this. I think that a lot of blockchains are trying to manage this now, quite frankly. So I've had lots of conversations recently with people in the organizations behind blockchains trying to explain the story and the narrative to investors, particularly in TradFi space. They're saying, well, actually, we need to tell you what we're doing now. It's kind of like a corporate rather than a decentralized blockchain.